Hi, I'm Michelle. Welcome back to Finally Revealed. In this episode, I want to talk about a mortgage. What is a mortgage? Sometimes it is actually a deed of trust, sometimes it's a trust deed, and sometimes it is a mortgage. Depending upon where you live in the U.S., these lien documents are called different things, and it's based upon that particular state law. Each state has different laws about how property is conveyed and how it is pledged in the situation of a loan, etc. But overall, people use the term mortgage to describe all of these different types of animals. And what it means is that someone has bought real estate and they did not have cash from their investments or their earnings or just cash lying around in their piggy bank to pay it to the buyer to buy the property. So they have gone to a bank or a credit union or a savings and loan or a private party and borrowed money in order to buy the land. And so that the party who is loaning the money can be repaid, they are taking a lien on the real estate, and that lien is what is the mortgage. It's a document that outlines what will happen if the money is not repaid. And generally what happens, although the specifics are different, again, state by state, in general what happens is if you borrow money and a mortgage is placed on the property and you don't make the payments as you are supposed to under the promissory note that goes with the mortgage, then the person who is holding the mortgage, who is called the mortgagee, can take the property away from you in satisfaction of the debt or partial satisfaction of the debt, meaning whatever the property is worth at that time, depending upon the different procedures for that particular state where the land is, you may or may not owe more money after they take it back. But the mortgage is the instrument that gives them rights in the property if you don't make the payment. The mortgage should be understood because it contains those rights. It provides for time limits once you fail to make a payment or if you fail to make a payment. And you should be familiar with those, because if something happens to your job or your situation and it makes you unable to make regular payments as you are supposed to, you should be acquainted with what the rights are and how your property can be taken away from you. Mortgage has other types of standard clauses that say if you sell the property without their permission, the mortgage is due and payable. It can also provide for an escrow for insurance and taxes so that you pay them, usually this is when it's a bank, in addition to the principal and interest on the note, you're also going to pay a percentage of the insurance, the annual insurance expense on the property and the annual taxes on the property. And the title company or the bank themselves will hold that in escrow, and once those bills come, then they will use your money to pay those bills. The mortgage can also contain sections talking about what happens if the city comes by and condemns all or part of the property for a particular purpose or because there's a problem with the property, and who gets the money for the condemnation. Likewise, insurance proceeds. If the property is destroyed and there is a house fire, the mortgage company or bank gets that insurance money to pay down on the debt. And then there may be provisions in the mortgage on how the two of you work out how the repairs will be made if they can be made. So there are various standard provisions, and then there are some that are going to be unique to where the property is located or the kind of property it is. But that, in a nutshell, is a mortgage. I hope this was helpful to you. If you have any comments or questions, leave them below. Please subscribe to see our other videos. You can also follow us on Twitter and Facebook. Thanks for watching. I'll see you next time.